the UK tax trick that makes a £20,000 investment actually cost you £10,000. Hi, I'm RUPA GANATRA-POPAT, the founder and managing partner of Arāya Ventures and House of Arāya. I manage over $50 million in venture capital funds. I'm backed by the British Business Bank, and I've co-invested alongside over 100 VC funds. If you're a higher rate taxpayer in the UK and you've never used SEIS or EIS tax relief, you are leaving money on the table every single year. I'm not talking about some tiny optimization. I'm talking about the government effectively covering up to half the cost of your investment upfront before you've even seen a single return. So yes, a £20,000 investment can genuinely cost you £10,000 net. By the end of this video, I'm going to show you the exact maths behind a £20,000 investment. You'll see what comes back, when it comes back, what happens if the company fails, and what happens if the company succeeds. No jargon, no vagueness, and no speak to your accountant and good luck. Just a clear explanation of SEIS and EIS tax relief in plain English. And once you understand it, you'll understand why so many experienced angel investors use the schemes as part of how they invest. So what is SEIS in plain English? SEIS stands for the Seed Enterprise Investment Scheme. It's a UK government scheme designed to encourage people to invest in very early stage companies by giving them tax relief in return. We can claim income tax relief at 50% on up to £200,000 a year. In plain English, if you invest in a qualifying startup, the government gives you back a large chunk of that investment through your tax bill. Why would they want to do that? The government wants more capital flowing into young UK companies, and early stage investing is risky, so they share some of that downside with you. It's broadly for any UK taxpayers who have enough income tax liability to use the relief and who are investing in companies that qualify for the scheme. HMRC says you can claim the relief once you receive a certificate from the company and reduce it in your next tax return or use it back one previous year. So you invest, the company later sends you a certificate, you can then claim that in your tax return. That's the mechanism, and that is why it's so powerful. Because unlike a lot of investing benefits that only matter if everything goes well years later, this one works early. Now let's do the actual maths. This is the section I really want you to see clearly, but we'll put the numbers on the screen. Let's say you invest £20,000 into a company that qualifies for SEIS. Under SEIS, the income tax relief is 50%. So that's 50% on £20,000, so that's your £10,000 you get back. And so if you have enough tax income liability, you can claim the full $10,000. And that relief comes to you in your self-assessment tax return. The claim can be made once you have the certificate, and that relief is a reduction in your income tax liability. So although you invested £20,000, your effective cost is $10,000. And this is the first big mental shift. You're not taking £20,000 of economic exposure in the way most people think you are. You are taking £10,000 net exposure, assuming you can fully use the relief. And now let's talk about the downside. So let's say the companies fail. That happens. This is a startup investing, and you have to assume some companies in your portfolio will go to zero. So if the company fails and your shares become worthless or are sold at a loss, there is additional loss relief available to you. And the available loss is calculated after reducing your cost by any income tax relief already given. So in this example, your starting point for the loss is not £20,000, it's the £10,000 net amount left after you claimed your SEIS income tax relief. And if you're a 40% tax band taxpayer, you can use loss relief against income that can reduce the actual economic loss further. So if the company fails, you've got your initial investment of £20,000, your income tax relief of minus £10,000, so your remaining exposure is £10,000. At a 40% taxpayer band, that means that your relief is another £4,000, so your total relief at this stage is £14,000, making your effective loss in this company £6,000. Now, that does not mean startup investing is safe, it just means that the government has structured a scheme to reduce the downside and incentivize investments. Now let's look at the upside as well. If the company succeeds and you hold your shares for at least 3 years, the gains on those shares will be exempt from capital gains tax. So if the company succeeds and exits after 3 years, your capital gain is potentially at 0% capital gains tax. And so the government helps on the way in, cushions the downside if the company fails, and also gives you more upside if the company does well. And this is why this scheme matters. Not because it removes risk, but because it changes the risk-reward profile in a very, very meaningful way. Now let's talk about EIS. EIS is the Enterprise Investment Scheme. Think of it as the bigger sibling to SEIS. It's typically used for companies that have already used up their SEIS allowance and now have EIS. EIS gives 30% income tax relief on up to 2 million of qualifying investments in a single tax year. So the relief is lower than SEIS, but the size limit is much larger. And here's the simple comparison. SEIS gives you 50% upfront in income tax relief. This is normally at the early stage of the company. And then it gives you up to £200,000 qualifying investment per tax year for you as an investor. You then get loss relief and you get capital gains tax relief if you've held the company for over 3 years in your portfolio. While EIS gives you 30% upfront in income tax relief and still the same benefits as loss relief and capital gains tax relief if you've held the investment for 3 years. And so just like SEIS, if you hold qualifying EIS shares, you get the same relief benefits. So SEIS is what companies typically raise first. When they have used up their SEIS, they start offering EIS to investors. Now here is the part people get wrong. SEIS does not magically turn a bad investment into a good one. Tax relief is not your return. Tax relief is a cushion, and that distinction matters. A weak founder with no real market, no real product, and no path to becoming a meaningful company does not become attractive because HMRC gives you downside protection. You still need to assess the deal properly. And I think about it like this. First, would I want exposure to this company at all? Second, does the tax relief improve the risk reward enough to make it so? That order matters. Because if you reverse it, you start chasing tax wrappers instead of quality, and that is where people lose money. The best way to think about SEIS and EIS is not how do I save tax, it's how do I invest in really strong early stage companies in a way that is more tax efficient? And that is a much better question. So where do qualifying deals come from? So now once you understand that the tax benefit, that immediately hits us on the next problem, which is where do these actual deals come from? Because finding one qualifying SEIS or EIS deal is not hard. Finding consistently good ones is the real challenge. This is a sourcing problem and the tax scheme is public. The hard part is access, filtering, diligence, and seeing enough opportunities to know what good actually looks like. And that's where most angels, and especially newer angels, struggle. Not with the tax form, but with the deal flow. Because if you're looking at 1 or 2 random deals a year, you don't have context, you don't have volume. You don't know what normal and what good looks like. And you don't know what a strong round looks like, what a weak one looks like, what a sensible valuation looks like, or which founders stand out relative to the market. That's why people naturally move towards communities, syndicates, co-investment circles, investor networks, and EIS funds like our Arāya funds. Not because they can't fill in a tax return, but because the real edge is in the quality of the opportunities and the quality of the thinking around them. Subscribe before you go, because next week I'm covering something that divides opinion every time I bring it up. I've built a free tool that does this calculation for you in about 30 seconds. You put in your tax rate and the amount you want to invest, and it shows you your exact income tax relief, your net cost, and your worst case scenario if the company fails. It's called the SEIS and EIS tax relief calculator. The link is in the description below. It's completely free. Just go in and run your own numbers.